Hello, friends. Welcome back to Book Demystified once again, and today we are going to discuss about the book Rule Number One by Phil Town. You know what's crazy? I was scrolling through Instagram the other day and I saw this post from some financial influencer showing off their Tesla and claiming they made six figures trading stocks last year. Meanwhile, I'm sitting here thinking about Warren Buffett, who's worth over $100 billion, still lives in the same house he bought in 1958 for $31,000 in Omaha, Nebraska, and drives around in a modest car. There's something seriously different about these approaches to wealth, right? Here's what really gets me thinking, and I bet this resonates with you too. We're constantly bombarded with get-rich-quick schemes, day trading apps promising instant wealth, crypto gurus claiming they can turn your lunch money into a fortune overnight. But what if I told you that the most successful investor in human history, Warren Buffett, follows a completely different playbook? What if the real secret to building lasting wealth isn't about timing the market, following hot tips, or gambling on the next big thing? Phil Town's Rule Number One isn't just another investing book. It's essentially a masterclass in thinking like Warren Buffett, taught by someone who went from being a river guide making $4,000 a year to building massive wealth using these exact principles. And here's the kicker. Town proves that you don't need an MBA from Harvard, you don't need insider connections on Wall Street, and you certainly don't need to spend your days glued to financial news channels. What you need is a systematic approach to finding wonderful companies at wonderful prices, and the patience to let compound interest work its magic. The promise of this book is huge, and after diving deep into Town's teachings, we're going to discover why Rule Number One, don't lose money, is actually the foundation for building extraordinary wealth. We're going to learn the exact four-step process that Town used to evaluate companies, how to determine what a business is actually worth versus what the market is charging for it, and why most Americans are unknowingly gambling with their retirement funds when they think they're investing. By the end of this, you'll have a completely different perspective on what real investing looks like, and you'll understand why Warren Buffett's approach has created more millionaires than any other investment strategy in history. So stick with me, because we're about to unlock the investing secrets that the Wall Street machine doesn't want you to know. Let me start with something that completely blew my mind about Phil Town's story, because it shows this isn't some theoretical, academic approach. This is real-world, life-changing stuff. Town was literally a river rafting guide in the Grand Canyon, making basically nothing, when he met an old guy who changed his entire perspective on money. This wasn't some Wall Street insider or finance professor. It was just a regular American who had gotten rich using Warren Buffett's principles. What's beautiful about this story is how it mirrors the experience of so many Americans today. Town was in his 30s, barely scraping by, watching his friends with real jobs, building wealth, while he was living paycheck to paycheck doing something he loved. Sound familiar? How many of us have been there, working hard, enjoying what we do, but realizing that passion alone isn't going to secure our financial future? The old man introduced Town to what he calls Rule Number One, which comes directly from Warren Buffett himself. Rule Number One, don't lose money. Rule Number Two, don't forget Rule Number One. Now, when most people hear this, they think it's just cute advice about being careful. But Town explains that this is actually the most profound investing wisdom you'll ever encounter. And here's why. Most Americans approach investing backwards. We focus on how much we can make instead of focusing on how much we might lose. We buy mutual funds because our 401k plan offers them. We chase last year's best performers. We invest in companies we know nothing about because some analyst on TV said they're hot. Town calls this investing, but really it's just sophisticated gambling with better marketing. Here's what happened to me that really drives this home. A few years ago, I put $5,000 into a tech mutual fund because it had been the top performer for 3 years running. I figured I was being smart, diversifying, following expert advice. Within 6 months, that fund had lost 30% of its value. Meanwhile, my buddy had invested the same amount in Coca-Cola stock using Town's approach, and while my tech fund was crashing, his Coke investment just kept paying dividends and slowly growing in value. The difference? My buddy had applied Rule Number One. He had thoroughly researched Coca-Cola, understood their business model, calculated what the company was actually worth versus what the market was charging for it, and only bought when he could get it at a significant discount to that value. I had essentially bought a lottery ticket with a fancy name and hoped for the best. Town breaks down what he calls investing like a business owner, and this is where his approach gets really powerful. He says most people buy stocks like they're buying lottery tickets. They hope the price goes up, but they have no idea why it should. Real investors, the ones who build lasting wealth, buy stocks like they're buying entire businesses, because that's exactly what they're doing. When Warren Buffett buys stock in a company, he's thinking about whether he'd want to own that entire business. Would he want to own all of McDonald's, all of Apple, all of American Express? And more importantly, would he want to own these businesses at the current price? This completely changes how you think about investing. Town teaches what he calls the 4 M's, a systematic approach to evaluating companies that takes the guesswork and emotion out of investing. The 4 M's are meaning, management, moat, and margin of safety. Let me break these down in a way that makes sense for everyday Americans, because this is the framework that can transform your financial future. The first M is meaning. You should only invest in companies that you understand. Town emphasizes that you don't need to understand every company, just the ones you invest in. Warren Buffett famously avoided tech stocks for decades, not because he thought they were bad companies, but because he didn't understand their business models well enough to value them accurately.
This is liberating for most Americans because it means you can stick to industries and companies you already know. Do you drink Coke or Pepsi? Do you shop at Walmart or Target? Do you use Microsoft Office or Google? Do you bank with JP Morgan Chase or Bank of America? You probably understand these businesses better than you think. Town's approach isn't about finding obscure gems. It's about recognizing great businesses hiding in plain sight. The second M is management. You want to invest in companies run by people who think like owners, not just employees. This means looking for CEOs and management teams who have significant ownership stakes in the company, who have long track records of success, and who communicate honestly with shareholders. Town teaches specific metrics to evaluate management, but the key insight is that great businesses are built by great leaders, and great leaders create long-term value for shareholders. The third M is moat. This is Warren Buffett's term for competitive advantages that protect a company from competitors. A moat might be a powerful brand like Disney or Nike, a network effect like Facebook or Visa, cost advantages like Walmart, or switching costs like Microsoft Office. The stronger a company's moat, the more likely it is to maintain high profits over time. Here's an example that really clarified this for me. Think about your cell phone service. How often do you switch carriers? Probably not very often because it's a hassle. You have to transfer your number, maybe buy new phones, deal with contracts, potentially lose coverage in areas where your current carrier works well. That hassle is a moat for companies like Verizon and AT&T. Customers stick around not necessarily because they love the service, but because switching is inconvenient and risky. The fourth M is margin of safety. This is where Town's approach gets really powerful and where most investors fail. Even if you find a wonderful company with great management and strong competitive advantages, you still need to buy it at the right price. Town teaches specific calculations to determine what a company is actually worth, and then he only buys when the market price is significantly below that intrinsic value. This is like finding a house that's worth $300,000 but being offered for sale at $200,000. You're not just getting a good deal, you're protecting yourself from mistakes in your analysis and giving yourself room for the investment to grow. Town provides detailed examples of how this analysis works with real companies, and the results are pretty amazing. He shows how applying these principles to companies like McDonald's, Walmart, and Microsoft would have generated returns far superior to broad market investing over long periods. We're not talking about modest outperformance. We're talking about turning $10,000 into hundreds of thousands or even millions over a couple of decades. But here's what I love about Town's approach. It's not about getting rich quick or beating the market every year. It's about consistently finding undervalued businesses and letting time and compound interest do the heavy lifting. Town shows how, even making just a few great investments per decade, using this systematic approach can build extraordinary wealth for ordinary Americans. He tells the story about a school teacher who used these principles to build a portfolio worth several $million over her career. She wasn't trading frequently, she wasn't following hot tips, she wasn't trying to time the market. She was simply applying the 4 M's to find great companies at great prices, buying them and holding them for years or even decades. This connects to something uniquely powerful about the American economy. We have access to ownership stakes in the best businesses in human history. Companies like Apple, Microsoft, Google, Amazon, and Disney generate billions in profits and return enormous amounts of cash to shareholders through dividends and share buybacks. But most Americans never participate in this wealth creation because they don't understand how to identify and value these businesses. Town also addresses the psychological side of investing, which he argues is even more important than the analytical side. He talks about how our emotions, fear, greed, impatience, overconfidence, consistently lead us to make poor investment decisions. The systematic approach of the 4 M's isn't just about finding good investments, it's about removing emotion from the decision-making process. He gives this example that really stuck with me about how most Americans react to market volatility. When the market is going up and everyone feels good, we want to invest more money. When the market is scary and falling, we want to sell everything and hide our money under the mattress. But this emotional cycle guarantees that we'll buy high and sell low. Exactly the opposite of what successful investors do. Town's approach flips the script. When you've done thorough analysis and know what a company is actually worth, market volatility becomes your friend rather than your enemy. If you know that Disney is worth $100 per share, but the market is selling it for $70 because of some temporary bad news, you're not scared. You're excited about the opportunity to buy more shares at a discount.
This psychological framework is crucial for American investors because our culture emphasizes instant gratification and constant action. We want to check our portfolios every day, we want to trade frequently, we want to feel like we're actively managing our money. But Town shows that the most profitable thing you can do is often nothing. Buy great businesses at great prices and let them compound over time. He talks about Warren Buffett's holding period for his best investments, and it's measured in decades, not months or years. Buffett bought Coca-Cola in the late 1980s and still owns it today more than 30 years later. He bought American Express in the 1960s and still owns it today. This isn't because he forgot about these stocks or got lazy. It's because these businesses have continued to grow their profits and pay increasing dividends year after year. Town also provides practical guidance on how to actually implement this approach in the real world, and this is where the rubber meets the road for most Americans. He acknowledges that most of us are busy with jobs, families, and other responsibilities. We can't spend 40 hours a week analyzing companies like professional investors do. But here's the beautiful thing about Town's system. You don't need to analyze hundreds of companies. You just need to thoroughly understand a few great businesses in industries you already know. Town suggests that most investors can build wealth by deeply understanding maybe 10 to 20 companies and waiting for opportunities to buy them at attractive prices. This might mean watching Disney for months or years, understanding their business model inside and out, calculating what the company is worth, and then pouncing when the market offers you shares at a significant discount. It's more like hunting than farming. Long periods of patient waiting, followed by decisive action when opportunities present themselves. Town provides specific tools and resources for conducting this analysis, including websites, financial databases, and calculation methods that make the process accessible to ordinary Americans. You don't need expensive Bloomberg terminals or professional research reports. Most of the information you need is freely available if you know where to look and how to analyze it. He also addresses common objections and fears that keep Americans on the sidelines. What if you make a mistake in your analysis? What if the company's business deteriorates after you buy it? What if the market doesn't recognize the company's value for years? Town's answer is always to return to the 4 M's and the concept of margin of safety. If you're buying wonderful companies at significant discounts to their intrinsic value, you have protection against most of these risks. Even if you're wrong about some aspects of your analysis, the margin of safety gives you room for error. He also emphasizes the importance of diversification, but not the kind of diversification that most financial advisors recommend. Instead of owning hundreds of companies through mutual funds, Town suggests owning maybe 8 to 12 companies carefully selected across different industries. This gives you enough diversification to reduce risk while still allowing your best ideas to meaningfully impact your returns. Hey, if you're enjoying our free book summaries and want to support what we do, there are a few easy ways to help. You can subscribe to the channel, become a member, or grab the book using our affiliate link in the description. And if you'd like to go a step further, you can also leave a tip via PayPal or UPI, the links below. Every bit of support helps us keep creating valuable content for you. Now let's talk about something that Town addresses directly because it's probably the biggest concern most Americans have about his approach. Doesn't this require way more time and effort than just buying index funds? And isn't it risky to concentrate your investments in just a few companies? These are fair questions, and Town doesn't dismiss them. He acknowledges that his approach requires more upfront learning and ongoing attention than passive index investing. But he argues that the potential returns justify the extra effort, especially for Americans who are starting with smaller amounts of money and need higher returns to build substantial wealth. Here's how Town frames it, and this really resonates with me. If you're investing $10,000, the difference between earning 7% annually, typical stock market returns, and 15% annually, what Town's approach can generate, might not seem huge in dollar terms initially. But over 20 or 30 years, that difference compounds into hundreds of thousands of additional dollars. For someone starting with limited capital, maybe a recent college graduate with student loans or someone in their 40s who's behind on retirement savings, those higher returns can be the difference between financial security and working until they die. Town argues that for these Americans, learning to invest like Warren Buffett isn't optional, it's essential. As for the concentration risk, Town points out that most Americans are already dangerously concentrated in their job, their local real estate market, and their employer's stock through 401k plans. True diversification means owning assets that perform differently under different economic conditions. And owning 8 great businesses across different industries can actually be less risky than owning 500 mediocre businesses through an index fund.
Town also talks about the tax advantages of his approach, which can be significant for American investors. When you buy and hold great companies for years or decades, you defer taxes on the gains until you sell. Meanwhile, mutual fund investors often pay taxes every year on distributions, even if they never sell their shares. Over time, this tax efficiency can add substantially to your returns. He gives this example of 2 investors who both earn 10% annual returns before taxes. Investor A uses Town's buy and hold approach and defers all taxes. Investor B owns mutual funds that distribute 2% annually, which gets taxed at ordinary income rates. After 20 years, even though both earned the same pre-tax returns, Investor A ends up with significantly more money simply because of tax efficiency. This is particularly important for Americans because our tax system heavily favors long-term capital gains over ordinary income. If you hold stocks for more than a year, you pay a maximum rate of 20% on the gains. 0% of your income is low enough. But mutual fund distributions are often taxed as ordinary income at rates up to 37%. That's a huge difference that compounds over time. Town also addresses the practical question of when to sell, because this is where many investors struggle. His approach is beautifully simple. You sell when either the company's fundamentals deteriorate, meaning it no longer meets the 4M criteria, or when the stock becomes significantly overvalued relative to its intrinsic worth. This is particularly important for Americans because our tax system heavily favors long-term capital gains over ordinary income.
If you hold stocks for more than a year, you pay a maximum rate of 20% on the gains, 0% if your income is low enough. But mutual fund distributions are often taxed as ordinary income at rates up to 37%. That's a huge difference that compounds over time. Town also addresses the practical question of when to sell, because this is where many investors struggle. His approach is beautifully simple. You sell when either the company's fundamentals deteriorate, meaning it no longer meets the 4M criteria, or when the stock becomes significantly overvalued relative to its intrinsic worth. This is particularly important for Americans because our tax system heavily favors long-term capital gains over ordinary income. If you hold stocks for more than a year, you pay a maximum rate of 20% on the gains, 0% if your income is low enough. But mutual fund distributions are often taxed as ordinary income at rates up to 37%. That's a huge difference that compounds over time. Town also addresses the practical question of when to sell, because this is where many investors struggle. His approach is beautifully simple. You sell when either the company's fundamentals deteriorate, meaning it no longer meets the 4M criteria, or when the stock becomes significantly overvalued relative to its intrinsic worth. This is particularly important for Americans because our tax system heavily favors long-term capital gains over ordinary income. This is very different from the emotional selling that most Americans do. We sell when we're scared, when we need money for something else, when we see better opportunities elsewhere, or when we've made a certain percentage gain. Town's approach removes all of this emotion and subjectivity. You have clear, objective criteria for both buying and selling. He provides examples of selling decisions using companies like IBM and General Electric, showing how changes in competitive position or management quality provided clear sell signals years before these stocks performed poorly. The key is having a systematic framework rather than making decisions based on market sentiment or recent performance. Town also spends considerable time discussing the importance of continuous learning because the companies and industries that dominate today might not be the same ones that dominate tomorrow. He talks about how Warren Buffett evolved from buying cheap, mediocre companies to buying wonderful companies at fair prices, and how individual investors need to stay flexible as markets and economies change. But here's what's reassuring about Town's approach. The fundamental principles don't change even as specific companies and industries evolve. The 4Ms work whether you're analyzing railroad companies in the 1980s or technology companies today. The concept of intrinsic value applies to any business that generates cash flow. The importance of margin of safety is timeless. This connects to something Town emphasizes throughout the book. You're not trying to predict the future or outsmart the market. You're simply trying to identify great businesses trading at discounts to their intrinsic value and letting those businesses compound wealth for you over time. The businesses do the work. You just have to be patient and disciplined enough to let them. Town provides numerous case studies of how this approach has worked with real companies over real time periods. He shows how buying Coca-Cola in the 1980s, Microsoft in the 1990s, or Apple in the early 2000s using his criteria would have generated enormous returns for patient investors. But more importantly, he shows how the systematic application of the 4Ms would have helped investors avoid disasters like Enron, WorldCom, or Lehman Brothers. The key insight is that when you really understand a business, its revenue sources, cost structure, competitive position, and management quality, you're much less likely to be surprised by negative developments. Town's approach forces you to ask the hard questions before you invest, not after you've lost money. One of the most powerful sections of Town's book deals with what he calls getting prepared, which is about developing the right mindset and habits for successful investing. He talks about how most Americans approach investing as a side activity, something we do with leftover money and leftover time. But he argues that for investing to be truly transformative, it needs to become a priority. This doesn't mean quitting your job to become a day trader. It means dedicating a few hours each weekend to learning about businesses, reading annual reports, and tracking companies on your watch list. It means treating your investment education as seriously as you treated your college education or professional development. Town provides specific recommendations for books, websites, and resources that can accelerate your learning curve. He emphasizes that the initial learning phase is front-loaded. Once you understand the principles and develop good analytical habits, maintaining your investment portfolio becomes much easier. He also talks about the importance of starting small and learning from your mistakes. Rather than investing your entire retirement fund using his approach immediately, he suggests starting with a small amount of money that you can afford to lose while you're learning. As you gain confidence and competence, you can gradually increase your allocation to this strategy.
This is particularly important advice for Americans because we tend to be all or nothing in our approach to new things. We either ignore investing entirely or we jump in with both feet without proper preparation. Town's approach requires patience and discipline, not just in holding your investments, but in developing your skills as an analyst. Town also addresses the social and cultural challenges of his approach. When you're buying individual stocks based on fundamental analysis, you're going against the conventional wisdom that most Americans follow. Your friends might think you're crazy for putting a significant portion of your money into 8 or 10 companies. Your financial advisor might discourage you from straying from traditional asset allocation models. But Town provides historical evidence that conventional wisdom in investing is often wrong. The mutual fund industry wants you to believe that professional management and broad diversification are essential, but the data shows that most mutual funds underperform simple index funds, and many index funds underperform great individual companies bought at the right prices. He talks about how Warren Buffett has repeatedly bet against conventional wisdom, buying companies when others were selling, holding cash when others were fully invested, concentrating his holdings when others were diversifying. These contrarian moves based on solid analysis rather than emotion have generated superior returns over decades. The beauty of Town's approach is that it aligns your interests with the long-term success of American business. When you own pieces of great companies, you want those companies to succeed, grow, and become more profitable over time. You're not betting against America or trying to time market cycles. You're betting on American innovation and entrepreneurship. This is fundamentally different from trading, speculation, or even broad market investing. You become a business owner, not a market timer. Your returns come from the underlying profitability of great businesses, not from market sentiment or timing luck. As we wrap up Town's Rule Number 1 system, let me give you the 3 most important takeaways that can transform your investing results starting today. First, you must understand that investing is not about predicting stock price movements. It's about buying ownership stakes in great businesses at attractive prices. This fundamental shift in mindset changes everything about how you evaluate opportunities and make decisions. When you start thinking like a business owner rather than a stock trader, you naturally focus on the things that matter: the company's ability to generate cash, the strength of its competitive position, and the quality of its management. Stock prices become secondary to business fundamentals, which is exactly how Warren Buffett thinks about investing. Second, the 4 M's, meaning, management, moat, and margin of safety, provide a systematic framework for evaluating companies that removes emotion and guesswork from your investment decisions. You don't need to analyze every company or follow every market trend. You just need to deeply understand a few great businesses and wait for opportunities to buy them at attractive prices.
This systematic approach protects you from the behavioral mistakes that destroy most investors' returns. When you have clear criteria for what makes a good investment and what constitutes an attractive price, you're much less likely to get caught up in market emotions or follow the crowd into bad decisions. Third, successful investing requires patience and discipline that most Americans struggle with in our instant gratification culture. Town's approach isn't about getting rich quickly. It's about getting rich surely. The biggest returns come from holding great companies for years or decades, not from frequent trading or market timing. This patience requirement is actually a feature, not a bug, of Town's system. It forces you to focus on truly great businesses rather than speculative investments, and it allows compound interest to work its magic over time. The Americans who build lasting wealth through stock investing are almost always the ones who buy great companies and hold them for very long periods. But here's the most important thing to understand about rule number 1. It's not just an investing strategy, it's a philosophy about building wealth through ownership rather than speculation. When you buy stock in Microsoft, you own a tiny piece of one of the most profitable companies in human history. When you buy Disney, you own a piece of a business that creates joy for millions of people while generating billions in cash flow. This ownership mindset changes how you think about market volatility. Instead of fearing price drops, you welcome them as opportunities to buy more shares of great businesses at lower prices. Instead of celebrating price increases, you view them skeptically, wondering if your companies are becoming overvalued. Town's approach works because it aligns with how great businesses actually create value over time. Companies that consistently grow their revenues, expand their profit margins, and return cash to shareholders will see their stock prices rise over long periods, regardless of short-term market sentiment. The American stock market has created more wealth for ordinary investors than any other wealth-building system in human history. But most Americans never tap into this wealth creation because they approach investing as gambling rather than business ownership. Town's Rule Number 1 system gives you the tools to participate in this wealth creation intelligently and systematically. The choice is yours. You can continue treating your investments like lottery tickets, hoping for the best while depending on others to make decisions for you. Or you can learn to think like Warren Buffett, evaluate companies like a business owner, and build wealth through patience and discipline rather than speculation and hope. Phil Town went from making $4,000 a year as a river guide to building substantial wealth using these exact principles. Thousands of Americans have used his system to take control of their financial futures. The question isn't whether Rule Number 1 works. Warren Buffett's track record proves it does. The question is whether you'll have the discipline to apply it consistently over time. Your financial future depends on the investing decisions you make today. Make them count by learning to invest like the most successful investor in history. Because when you follow Rule Number 1, you're not just buying stocks, you're buying your financial freedom, one great business at a time.